So, in the last few days, we've had a US election and a rather stunning collapse of the German coalition government. But there were no surprises from the Bank of England's Monetary Policy Committee at their November meeting. They very much stuck with the consensus expectation, which was for a 25 basis point cut, leaving bank rate at 4.75%. And they retained their rather hawkish tilt in terms of their rhetoric. And this was despite the fact that actually economic activity in the UK has been coming in a little bit softer than expected. And the reason for that is really twofold. Firstly, the Bank of England see that the impact of the past inflation shock is still working its way through the UK economy. They want to see more evidence that services inflation is coming off. They want to see more signs that nominal wages are really starting to ease. But a second reason for that retaining of a hawkish tilt is because the Bank of England now also see new inflationary pressures bubbling up on the horizon, not least those coming from the UK budget, which was only just announced at the end of October. And there they see the budget as pushing up on UK economic activity, of pushing up on inflation, so much so that they don't now expect inflation to return to the 2% target until 2027. So the bottom line for us is that the UK monetary policy very much remains in a higher for longer world, where bank rate is probably going to stay on hold at their December meeting. And we continue to expect that the UK is going to see rates that are just a little bit higher for a little bit longer than their two key main trading partners, the US and the Euro area.